Well, thank you for joining us and really looking forward to having this conversation today. My name's Kevin Tiernan. I'm one of the senior advisors and partners here at Durbin Bennett. I'm joined here by our very own Matt Chikimiak, our Chief Investment Officer. And Matt, as always, thank you so much for the time.
Great. I'm happy to be here.
Good, good. Well, I'm glad you're happy to be here, Matt. From our last video, Matt, we really looked at what happened in 2023. For this video, what we want to focus on for our clients and for staff as well is really how are you thinking about 2024? It was, I'd like to say, an interesting year, but it was a hard year to predict last year, and we're not asking you to predict it for this year. But I really want to tap into what are the things you're focusing on, and what are the maybe themes in the market that you and the investment committee are looking at for this year.
Yep, absolutely. Yeah, I mean, as we always joke at the investment committee, when someone says, what's going to happen next year, we say, we'll pull out our magic 8-ball and we'll try and figure that out. But in all seriousness, the way we think about it is we try and put structure around it. And so we're always thinking about what are the challenges that are out there and where are the opportunities or the positives that investors should be thinking about. And, I bring it back to, these old adages that are used on Wall Street that, the market really climbs a wall of worry. Yep. And I think that's no different than what happened last year. And probably what will happen this year. So let's focus in on challenges to begin with, because I think that's the way the popular press is trying to sell papers, and it tries to scare people into doing things. And as everybody knows, we're much more kind of stable, and we want to keep a portfolio that is evergreen. It's durable for a multitude of economic environments, and we want to think about how we can benefit in these challenging environments, because there's always challenging environments.
Absolutely.
So the first challenge is, as I see it, and thing that is going to dominate the presses for the next, call it 9 months, is the election. Whether we want it or not, it's probably going to be Trump versus Biden. And we remember how that went last time. It was so cordial and non-polarizing. It'll probably be the same this go around. I think if you look at kind of the pundits and what ultimately will happen, A, I don't think anybody knows. No. And B, if you look at kind of the polls today, it's probably about a 50-50 split, depending on who you look at. And I think for us, I think it's going to be noise. I think both will probably do a great job. And the way our democracy is set up is one that's based on checks and balances. And so nobody has an exorbitant amount of power to do anything major. Everything has to be done through Congress, the Supreme Court, and the executive branch. So that's the way it was always set up, and that's the way it will work. Yeah. I think additionally, if we think about just the economy as a whole, the Fed finally has, given what we saw last year, they feel like they have put some controls on the economy from overheating. Inflation has come down. And so we should be watching for unemployment rates going higher. We've seen a number of layoffs occurring over the last 3 to 4 months. I think that will continue, potentially even accelerate. Yep. I think inflation, yes, it's under control. We'll see how that goes. GDP, economic growth. I don't know if we go negative, but I think it definitely slows down from here. And so, the real question is the Fed going to be able to engineer a soft landing, or is it going to be a hard landing? Yeah. Yep. Who knows? It remains to be seen. I think from our perspective, inflation is probably the bigger wild card, because that's really what the Fed is looking in at. And every time that they release their language, they talk about unemployment, they talk about GDP, but they're saying our target is inflation. Yeah. We want to keep it somewhere around 2%. Inflation is kind of that silent killer in an economy if it runs too hot for too long a period. And so they need to keep it around 2.5%. We're at 3.4. So I think they're there. I think some economists I've seen would suggest that inflation will continue to abate. Okay. I've seen some economists that would suggest that we could see a reacceleration. Wow. And some of that would be based on the fact that rental rates could go higher, because real estate prices could potentially, because of what interest rates have done at the end of 2023, when the 10-year went from 5% down to sub 4%, we saw a re-stimulation in some of the real estate markets. So that's something to watch. I'm not concerned about it, but it's something to watch. Okay. Geopolitically, I think some people have become numb to the fact that, there's a war going on in Ukraine and Russia. We thought there could be some global issues associated with that from a commodity perspective, oil, natural gas, other commodities like grains, but ultimately has not happened yet. And it's, I guess we're coming up on 2 years plus on that conflict. The other one, which potentially has, something that could grow into something larger, is Israel-Palestine. It feels like there's a lot of, things that would suggest that there are countries that are trying to drag in the U.S. and other NATO countries into this conflict. Hopefully that isn't the case. I don't want this to become, a very large, issue, because that could be a problem for the economy as a whole and just putting additional uncertainty into the market. So again, those are things out of our control. The last one is market valuations. Again, if you've watched our 2023 video, you know that the Magnificent Seven really pushed the S&P 500 PE substantially higher, and probably the fundamentals there are not there to support it. But if we strip those out, we do look at valuations that look much more reasonable. It doesn't mean that it's cheap. It's still expensive, but it's much more reasonable than what we're seeing on the blended rate, including the Magnificent Seven. Okay. Now, with the challenges, kind of fully in front of us, and again, there could be some other exogenous events that we can't plan for. If we think about the positives that are out there, the first one is this, potential rate cut that could be coming from the Fed in 2024. Again, the Fed is suggesting, based on the Fed dot plot, that rates could go down 75 basis points this year. The market actually, after the December meeting, was predicting 150 basis points. That's probably a little more aggressive than we would have expected. I think if we get to the 75 and maybe a little bit more, I think that's going to be very stimulative for the economy. There's probably reasons why the Fed is doing it as well, because the GDP is, going down, maybe even pushing into negative, meaning that maybe we're actually hitting a recession, but maybe it's a soft landing, who knows? But again, back to the old adage, don't fight the Fed. When the Fed starts cutting rates, that's typically a time to be taking risk, and so not to be fearing what's happening in the market. I think the other major thing that's out there, and the popular presses are starting to catch on to this, is that there is a large amount of cash sitting on the sidelines. Today, there's over $6 trillion sitting in money market funds. And again, if the Fed is starting to cut rates, what was getting me 5% plus, if the Fed starts cutting rates, that's going to go lower. And so the Fed is, again, trying to be stimulative to the economy, but also suggesting to those folks that are sitting in cash that now is a time to go and take risk, because you're getting paid less for that cash. And that cash will have to go somewhere. So it'll buy probably investment grade bonds, high yield bonds, and stocks, right? And so when more cash comes in, it's a supply and demand. We think that stocks will probably go higher from here. Valuation wise, we talked a little bit about the US being expensive, but on a relative basis, where we do find things that are cheap are developed international as well as emerging markets. So this is one of the cheapest on a relative basis those markets have been relative to the US. And so I think as we build our globally diversified portfolio, we've been that way for years, that will benefit us, because international markets haven't done all that well over the last couple of years, because it really has been a US-centric story from a stock perspective. Some of that could be changing over the next couple of years, because valuations are so much better globally as opposed to the US. So that's exciting. I think the last thing is, if we think about our satellites, if we think about an environment where interest rates are coming down, we've already started to see that on the 10-year Treasury, is that will be stimulative for our real asset position. So think about real estate, think about infrastructure, other things that are long dated with cash flows should be beneficial. So I think some of the pain that they felt in 2023 will probably start to reverse itself in 2024. And our managers are again, much more conservative. And so I think they've been taking advantage of an environment where it's definitely been a buyer's market as opposed to a seller's market. So that makes me excited that as that starts to reverse, we're going to see the benefit of being conservatively positioned going into all these interest rate increases and having balance sheet flexibility to take advantage of it.
Matt, when we sit down and have these conversations, the idea of this all-weather portfolio always comes to my mind. We don't know what's going to happen next year, but we want to own assets that can perform well in any market environment. And again, that takes us out of the prediction game, and that takes clients out of, hopefully, the worry game. So, Matt, with that, as always, I just want to say thank you. These conversations are helpful for me. I hope they are helpful for you as clients as well. Going forward, if there are any other topics you want us to cover, by all means, please reach out, talk to your advisor about them. We want your feedback on these. And additionally, later on this year, we are going to be creating a longer format video to share with clients where Matt and the entire investment committee really go deeper into our portfolios, what we own, how they behave, but also how we're positioned for the remainder of 2024. So with that, Matt, I want to say thank you again. And for everyone out there joining us, thank you so much. Have a great year. We look forward to seeing you soon. Take care.